Good day everyone, my name is Rosidaya binti Mustaqim, metric number BB24110781. This presentation is part of the Financial Management course at University Malaysia Sabah. I will be presenting an analysis of Nestle Malaysia Berhad's financial performance over the years 2020 to 2024, highlighting key ratios, strengths, weaknesses, and investment recommendations. Next is this introduction of Nestle Malaysia Berhad. Nestle Malaysia is one of the most recognized food and beverages companies in the country. Incorporated in 1912 and listed on Bursa Malaysia since 1989, it operates major brands like Milo, Maggi, Nescafe, and KitKat. This analysis evaluates Nestle's financial strength and sustainability over the past 2 years to determine whether it remains a strong investment in the food and beverages industry. So this is the methodology that I use to analyze Nestle financial health. I use data from the company's audited financial statement from 2022 to 2024. Key financial ratios were calculated across 5 categories: profitability, liquidity, solvency, efficiency, and market valuation. The analysis includes trend comparison and benchmarking against a key competitor, Fresh and Nif Holdings Berhad, to evaluate Nestle's relative standing in the industry. This is profitability ratios. As you can see, profitability ratios reveal a downward trend. Return on asset declined significantly from 18.49% in 2023 to 11.39% in 2024. Return on equity, although still high at 75.91%, fell from nearly 100% in 2022. Net profit margin dropped from 9.36 to 6.68% in 2024, indicating reduced profit per margin of sales. The gross profit margin was relatively stable. In 2022, the margin was 30.92% and it improved slightly to 31.64% in 2023, suggesting control over production costs. In 2024, it declined to 30.28%, a minor decrease that may reflect a small increase in the cost of goods sold or slight price reduction. This suggests declining profitability, like due to higher costs or weaker revenue growth. And then move on to liquidity ratios. Nestle liquidity is a major concern. The current ratio dropped from 0.71 to 0.55 over the 3 years, indicating difficulty in covering short-term liabilities. The quick ratio remained below 0.25 in all years, suggesting that most current assets are tied up in inventory. These figures imply possible reliance on short-term borrowing to meet. And then solvency ratios. In terms of solvency, Nestle remains mostly equity finance. The debt-to-equity ratio was low at 5.67% in 2024, but slightly higher than previous years. The interest coverage ratio, however, fell from over 20 times in 2022 to 9.49 times in 2024. While the company can still meet its interest obligations, the declining trend could signal rising finance costs or lower earnings before interest and tax. Next one is efficiency ratios. Nestle continues to show strong operational efficiency. Receivables and orders stood at an impressive 42.41 times in 2024, showing strong credit collection. Inventories and over improved from 4.13 in 2022 to over 5 times in the last 2 years. Asset turnover, however, dipped in 2024, which may suggest underutilization of assets or reduced sales growth. And the last one is market ratios. In 2024, earnings per share declined sharply from 2.81 to 1.77, reducing returns for shareholders. Despite this, the price-to-earnings ratio rose to 56.49, likely due to continued investor optimism or speculative buying. A high price earning with falling earnings could be a warning sign, as it suggests the stock may be overvalued. And then this is the industry comparison. Now let's take a look at the radar chart, which visualizes the key financial ratio for Nestle Malaysia Berhad and Fraser and Neff Holdings in 2024. This radar chart presents a side-by-side comparison across 11 key financial indicators grouped under profitability, liquidity, solvency, and efficiency ratios. For profitability, starting with profitability, we can see that Nestle significantly outperforms Fresh and Neff in return on equity and asset turnover. Nestle ROE is exceptionally high, indicating very strong return to shareholders. This suggests that Nestle is using its equity base very efficiently to generate profit. However, F&N has a higher net profit margin, reflecting better cost control relative to its revenue. And then for the liquidity, Fresh and Neff clearly stand out. The current ratio and quick ratio are well above those of Nestle, suggesting that F&N is in a stronger position to cover short-term obligations. In contrast, Nestle liquidity ratio are quite low, which could be a potential red flag regarding in short-term cash flow management. For solvency, we observe a significant contrast. Nestle debt-to-equity ratio is much higher, meaning it relies heavily on debt financing. On the other hand, F&N maintains a conservative debt profile and has a very high interest coverage ratio, which demonstrates its strong ability to service debt. Then move to efficiency. Efficiency ratios further favor Nestle, especially in receivable turnover and asset turnover. This means Nestle is better at converting its receivable into cash and utilizing its asset to generate sales. In summary, the radar chart shows Nestle as a high-performance, high-risk company with strong profitability and operational efficiency, but weaker liquidity and higher leverage. Meanwhile, F&N represents a more balanced and conservative approach with stronger liquidity and solvency but lower profitability and efficiency. Next, risk and strength. Nestle Malaysia shows strong financial performance in several areas, most notably in returns on equity is exceptionally high at 75.91%, which reflects efficient use of shareholder funds. It also has strong asset and receivable turnover, indicating good operational efficiency. In addition, Nestle's earning per share and price to earning ratio suggest solid investor confidence. On the other hand, Fresh and Neff excel in liquidity and solvency. It has a strong current and quick ratio, meaning it can comfortably meet short-term obligations. It also maintains a low debt-to-equity ratio, showing financial prudence, and high interest coverage ratio, which indicates strong debt servicing capacity. Now, the weakness. Nestle's main concern is low liquidity. Its current and quick ratio are below 1, which could pose short-term financial risk. Also, the company relies heavily on debt as shown by its high debt-to-equity ratio of 4.67. Meanwhile, FNN's weaknesses lie in its lower profitability. Its return on equity and return on assets are significantly lower than Nestle. It also shows lower efficiency in using its assets and collecting receivables. And finally, potential risks for Nestle. The key risks include over-leveraging and liquidity pressure, which may affect flexibility during downtimes. For FNN, the risk is that weaker profitability and operational inefficiencies could limit long-term growth and competitiveness. Overall, Nestle is a high-performing but high-risk company, while FNN is more stable and conservative but needs to improve profitability and efficiency. So, in conclusion, Nestle Malaysia remains a profitable and efficient company but faces risks related to declining liquidity and profit margins. Although return on equity remains high, signs of weakening earnings and cash flow management must be addressed. My investment recommendation is to hold. Investors should watch the company closely over the next few quarters to see if it can stabilize its financial position and improve profitability. So now is Q&A session. I got 3 questions from my friends. Question 1. Why does the Nestle such a high return on equity compared to FNN? So to answer this, Nestle return on equity is significantly higher because the company uses a large amount of debt financing, which amplifies return to shareholders. This financial leverage increases profitability ratios like ROE, but it also comes with higher financial risk, as seen in their high debt to equity ratio. And then move to question 2. Should investors be concerned about Nestle low liquidity ratio? My answer is yes, because low liquidity ratios like a current ratio of 0.55 and quick ratio of 0.20 may indicate short-term cash flow issues. While Nestle is profitable and efficient, investors should monitor whether the company can meet its short-term obligation without refinancing or asset sales. And the last question is, between Nestle and FNN, which company is more suitable for risk-averse investor? So from my perspective, FNN, which is fresh and new, would likely be more suitable for risk-averse investor. This is because it has a more conservative capital structure, strong liquidity, and better debt management, while its profitability is lower than Nestle, but its stable financial position reduces exposure to financial distress. So that is all from my presentation. Thank you for watching and listening.